morning, everyone. I'm delighted to be back in Dubai with my friends from Global Reinsurance, the IIS. I also want right up front to thank Emirates Airlines for their sponsorship here today. As someone who flies more than 250,000 miles a year and could practically write a guidebook on airlines, I appreciate the superior product that Emirates offers. I'm happy to be able to be with you today to share a little bit of the global perspective on the insurance industry from my role as CEO of the IIS. I'm pleased to see several IIS members here today, but I know that there are probably many of you who are not familiar with my organization, so I'd like to take just a couple of minutes to give you an overview. The IIS is the industry's oldest and largest association of global insurance professionals. We were established in 1964 and now have members in 95 countries. Our unique membership structure is comprised of senior life and non-life company executives, national insurance regulators, and insurance scholars. We also have insurance advisors such as brokers, consultants, actuaries, accountants, asset managers, etc. Another unique characteristic of the IIS is our mission to promote a cross-border exchange of ideas and strategies as an open and objective forum, not in any way in an advocacy or lobbying role. There are plenty of organizations that around the world that seek to influence policymakers, and they're certainly entitled to do so. That's just not our mission. Our role is to sponsor and facilitate applied research that enables our very diverse membership to better understand and address the issues that the industry faces with better intelligence. We do this around the clock and throughout the year through a series of interactive web-based services that at last count had been viewed and used by people in 180 countries, and I hope no one asks me to name them. Although these web-based services are important in this world where the web is the way people exchange and get information, our most important activities are very much of the physical world rather than of the cyber world. The IIS manages the Insurance Hall of Fame, the ultimate tribute for the true industry giants who have made a lasting contribution to the industry through their vision, through their efforts. We also sponsor and judge in partnership with our friends at the Geneva Association, the Shin Research Excellence Awards. These awards for applied research are supported by an endowment from the Shin family of Korea's Kyoto Life Insurance Company. The annual Insurance Hall of Fame induction and the selection of the Shin Research Award winners are made at the crown jewel of the IIS, which is our annual seminar. This event, widely recognized as the global industry's most prestigious conference, typically brings together more than 500 industry leaders from more than 50 countries. We presented a fantastic seminar in Oman in 2009, and our first, and I'm sure not our last, seminar in this part of the world. In June 2014, we'll present our 50th annual seminar in London. It will be very special. I hope many of you will be able to join us. Now, I've been asked to share with you some insights from the recently concluded seminar in Seoul, our 49th, and just a few weeks ago. There are 8 themes I'd like to comment upon in the time allotted to me today. I'll try not to run over. The first one was really the overarching issue of demographic changes. Management guru Peter Drucker once said that demographics is the part of economics that the experts think about least, and when they do, they usually get it wrong. Well, the insurance industry is certainly beginning to think about demographics a lot, and it's vital that we do get to understand it better. Setting the tone for more focused discussions about product and marketing strategies, we presented some conceptual papers about the key demographic issues, the challenges of providing for financial and healthcare, security for the rapidly aging populations, mostly in the northern hemisphere, and the designing affordable and available coverages for the exploding young population, mostly of the southern hemisphere developing countries. This topic permeated many of the more specific discussions that followed. One issue that generated not only differences of opinion, but some actual heated argument, was how to define the best regulatory framework. On a global basis, there's still a real disconnect between how insurers and regulators view the trade-offs of the push for more active, some would say more invasive regulation of the industry after the financial crisis. Our membership not only feels that the financial and the human cost of the avalanche of new and proposed rules is excessive, but that the confusing and often conflicting objectives of these new aspirations is not only unproductive, but is really counterproductive and stifles innovation to the detriment of our policyholders. The dominant view expressed at the seminar, again, 500-odd people from this year, 53 countries, was the frustration that policyholders, the policymakers, continue to fall back on the belief that requiring more capital will result in fewer problems. Failing to understand, we think, the differences in the funding and liquidity models of insurers versus banks. Designing a functioning system to provide for the financial security of the agent was a very major topic of discussion this year. There have traditionally been three pillars of older age financial security, and they've all been shown to have serious flaws in recent years. Government-provided pensions are clearly incapable in most countries of providing adequate security. Corporate pensions have, to put it mildly, been restructured and much diminished in recent years with the shift from defined benefit plans to defined contribution plans. Finally, the private savings have fallen, unable to offset the collapse of the first two pillars due to low employment levels and stagnant incomes. This is a huge societal problem. The IIS took part in a discussion at Harvard University 2 weeks ago at the National Bureau of Economic Research. Government policymakers and industry are deeply, deeply concerned about this issue. Natural catastrophes were a major topic of discussion at the seminar. The insights of insurers and brokers on this topic were augmented by the views of natural scientists knowledgeable about meteorological and tectonic elements of the issue. The consensus was that the trend of more frequent and more severe cats will likely continue due to climate change. In addition to the normal hurricane and tornado type activities we all expect from time to time, the experts foresee more unusual losses like the Thai floods, the Japanese earthquake. The reinsurance industry, which seems awash in capital to many people, may need all the capital it has and more to cope with this loss outlook. Low interest rates and resulting low return on fixed income investments were another topic of great concern at the seminar. Life and non-life insurers alike have found it virtually impossible to generate adequate returns on capital with rates at current levels. Most insurers are suffering a decline in yield of about 300 basis points between maturing bonds and the rate at which they're able to reinvest the proceeds. Insurers are re-examining their traditional investment strategies in an effort to find greater yield without sacrificing too much liquidity or safety. We see increased commitments to equities, alternative assets, private equity, and even some direct investment in emerging markets and infrastructure type debt. We believe that lower returns and more accommodative attitude by banks about lending will spur more industry consolidation. Many insurers find themselves unable to make the technology and investments required to compete successfully in today's environment, and many others cannot afford or manage the rapidly escalating cost of regulatory compliance. Expect to see more mergers among non-life companies and especially among life insurers. Another major industry influence, and one that also has a bearing on the outlook for accelerating industry consolidation, is the war for talent. The insurance industry has historically not been the employer of choice for most of the best and the brightest young talent. The few insurers that have made a serious commitment to hiring, training, rewarding, and retaining top talent are clearly opening up a performance gap versus their peers. In my 42 years in the insurance industry, I've never seen a level of concern and evidence of serious effort in the industry to rectify this problem like I'm seeing right now. And I'm gratified to see so much high-level attention being paid to the intellectual capital that underpins our industry. Finally, the IIS annual seminar I want to mention is the United Nations Environmental Program Finance Initiatives, Principles of Sustainable Insurance. At our 48th annual seminar in Brazil in 2012, the UN launched the Principles of Sustainable Insurance and with the cooperation of a group of committed industry executives. The UN constructed a set of environmental, social, and governance guidelines for the insurance industry to show the way towards sustainability for the global insurance industry. And at this year's annual seminar, the PSI program, as it's known, the director returned to describe how the program has grown to nearly 50 major insurers worldwide, and he has demonstrated that adoption of the principles is not an act of charity undertaken at a cost to the bottom line, but on the contrary is beneficial to the long-term performance of the participating companies. The IIS is proud to be a founding supporting institution of the Principles for Sustainable Insurance, and we're pleased to see such a high level of interest by our membership. These are some of the key takeaways from the recent IIS seminar. The issues expressed as those of great concern to our 95-country membership. Now I'd like to share with you our perspective on the 2013 Monte Carlo Rendezvous, the 57th meeting of the world's largest reinsurance leaders. The dominant theme of this year's rendezvous, for those of you who were not there, was convergence, an enormous inflow of reinsurance capacity from the financial markets. Now, cat bonds and other insurance-linked securities have been around since the mid-90s, but have really come of age only recently. The worldwide property cat market is now about $300 billion, and insurance-linked securities have gotten to represent about $45 billion, or about 15% of the total. 35 to 40% of North American catastrophe risk is now supported by the insurance-linked securities market. That's clearly the focus of this activity. The inflow of capital from the financial markets has led some reinsurers to redeploy some of their capital to other classes of business. Some have speculated that up to $20 billion of capacity could be redeployed by traditional players to casualty lines, which would be like adding another 10 new Bermuda startup reinsurers, each with $2 billion. So the potential disruption of the marketplace is much wider than just what's going on in U.S. cat risk. The debate in Monte Carlo is largely over the reliability and further growth potential of this market. Some of the incumbents are predictably dubious about the convergence trend. They foresee abrupt pullouts from the market if major losses occur, difficulty in adequately handling claims, a tendency to rely on the most optimistic risk models, and a host of other concerns. Many of these can seem to be self-serving. Other participants, like the brokers, Guy Carpenter, Aon, and even a few of the leading carriers like Hanover Re, feel that we're already in a post-convergence world and that the industry had better just adapt to this new reality. My feeling is that the incumbents that work with the new world of capital markets involvement will do better over the long term than those who fight it. Other issues that were thought-provoking at this year's rendezvous included the numerous alliances of reinsurers, especially the newer ones, are forging with asset management firms. The success that several hedge fund firms have had of building respectable reinsurance companies, primarily as a way of gathering permanent assets, has led a number of reinsurers to try to reverse engineer this process by joining forces with world-class fund managers to enhance their portfolio returns. There was much discussion of reinsurers expanding their reach beyond their traditional scope to seek more access to primary business, as well as long-tail casualty business and specialty lines. Several leading brokers discreetly expressed great concern about second-tier reinsurers. Many, if not most, smaller reinsurers have subpar analytical capabilities and are losing talent to the dominant major companies and to the hedge fund-backed startups. It's getting harder for these second-tier players to differentiate their business models in an increasingly complicated market. And these trends may presage further consolidation in the reinsurance market. All in all, there was a general acceptance that in spite of low investment returns, a relatively benign catastrophe period has helped insurers deliver good results year to date, which in turn puts pressure on rate levels. Most Monte Carlo participants weren't even talking about whether January renewals would be lower or not, just about how much lower they would be. Most seem to expect casualty rates to continue to drift lower and North American cap business to be down at least another 5 to 10%. Let me conclude my presentation this morning by synthesizing the takeaways of the IIS annual seminar and the Monte Carlo rendezvous, looking ahead a bit in terms of the global market perspective. First of all, convergence is clearly driving more focus on core skill sets. And by that, what I mean is it's requiring more insurers to think hard about what their core skill sets are and what are not. For instance, most insurers would define their core skill sets as including risk assessment, risk pricing, perhaps claims management. Most would honestly say that asset management and capital formation were probably not their core skill sets in the capital markets, and the asset managers are proving to be very good and perhaps better at that. So I hear, as I visit CEOs around the world, more talk about focus on core activities. Regulators, I'm sorry to say, tend to be driving insurers to invest inefficiently. Traditionally, the regulatory regimes have assigned capital charges to different classes of investments. What have they defined as the safest investments traditionally? What can be safer than government bonds? Well, if you think of the safest assets, I have some friends at Generali who own a lot of Italy bonds that might feel otherwise, and you could name some other countries as well. Regulators have discouraged investment in equities. They've discouraged investment through capital charges in illiquid assets like private equity and other such things that have tended to produce superior returns over the long term and recently have shown themselves to be less volatile than the government bonds that many regulators seem to prefer. So I'm concerned looking ahead about how regulators are driving insurers to invest in an efficient manner. I foresee public-private partnerships on the rise in both the life and non-life sectors of the industry. In the life industry, clearly, governments are shown to be capable of providing for old age financial security. The industry can't do it on its own, and I'm encouraged. In fact, I've had some meetings in Washington and elsewhere to see that governments are working together to try to put together their thoughts on how to help solve the problem cooperatively. On the non-life side of the business, with respect to catastrophe risk, I also see more dialogue between public institutions and private organizations about how to not only write checks after losses occur, but how to mitigate and in some places even reduce losses for the benefit of all. I also want to mention that those who are able to harness big data will win. Now, the collection of data sets as large and complex as they are today presents both opportunities and challenges for insurers, leading to a separation of winners and losers as I see it now. Few companies have the human or the financial resources to really capitalize on the big data trend, and this again, I think, is going to accelerate industry consolidation. Finally, I want to say that the insurance industry seems to me and I'm happy to say this, increasingly seen as a force for good in our society. Insurance industry has not had a great reputation with consumers over the years, unfairly so, but we've seen a number of examples recently of how the industry has raised its profile in a very positive way. In the wake of the Tohoku earthquake and tidal wave, the Japanese life insurance industry led the effort. They didn't just participate, they led the effort to make the lives of those affected in Northeast Japan better. The same is true in Thailand, the same is true after Hurricane Sandy in New York. And I'm increasingly starting to see more people understand that our industry isn't just a transfer payment mechanism, but something that actually increases the functioning of our civil society. So I want to stop there to give the other folks a chance to speak. So let me say, shout out to my friends at the DIFC, Global Reinsurance, and especially to all of you for coming today.